You know that it means so much, and you don't even feel a thing. I am falling, I am fading, I am drowning. Help me to breathe.
Hello, everyone, and we are back to the second part of this first ever two-part series or two-part episode on the same topic of financial literacy. My name is Karan, and I'm your today's host for Classroom to Campus, or this episode of it. This is that podcast that has been helping you so far transition from high school to university or another post-secondary education, especially if you are graduating.
And I'm your co-host Muhammad.
Yes.
So in today's episode, I will get to the other 2 points of financial literacy.
Yes.
Which are investing and managing your credit.
Now,
but before that,
if you are listening in on YouTube, give us that like, comment on our videos, and hit that subscribe button. And if you're listening in on Spotify, then
please don't forget to give us that 5-star review.
it really helps.
Now, before we start off with these topics, Karan, let's get back to our debate.
Sure.
You mentioned that housing isn't necessarily the safest form of debt, right? But I tend to disagree. I've even researched it, and according to the CNBC, housing is the safest form historically of debt.
Yes.
And it all boils down to the market.
Yes, especially the interest rate and all of that.
So it all boils down to if the market's strong, if the market's weak.
Yes.
So you definitely have to be prepared for that, and you have to consider with every risk comes there's a potential greater reward.
For growth as well as depreciation. And that's what I was saying. It's not necessarily a debate about how buying a house good or bad. It's about making sure that when you are buying a house, thinking that it would be good for how much return you can have on it, consider factors like physical depreciation. I talked about it a little bit, but it's basically when your house, it's in its physical structure, it's starting to deteriorate. It can be caused by factors like neglect. You haven't been in that property since 20 years, and now it needs extreme plumbing and cleaning.
That's why renovations and maintenance is key.
Exactly. Now that was my point. And in terms of or there could also be, what if there's a natural disaster?
Yeah.
That can really...
But you should have insurance on your house necessarily.
Exactly. However, if a house experiences significant water damage in that particular area as well, then that can be harmful as well. Now, it's not just that. What about there's functional obsolescences? Now, for those of you that don't know what that means, what if your house has outdated features or design elements that modern buyers don't want? That house is not going to be might not sell for the amount of return that you wanted on it initially, especially when buying that house. So it's important that you either renovate, like Muhammad mentioned earlier, or make sure that you're buying a house with a kitchen that's not very outdated, a bathroom that has a shower, basic things that modern buyers may need. Now, there are other factors. What if your neighborhood's changing, like I mentioned? That can affect that house's value as well. For example, if this house was in this once desired neighborhood, and now it has increased crime rates, or if the constructions or there are undesirable facilities nearby. What if the legal zoning that or the zoning that there was earlier changes? What if there are now regulations that don't allow the residents to live the life that they wanted?
There's an endless possibility of things that can happen. So
Exactly.
Remember, guys, consult your financial advisor and
Yes.
always make informed decisions. And remember that with reward there's always a risk.
Opportunity as well. And on that note, also be sure to actually get yourself a financial advisor, as without them, I feel you'll be a pawn in the game of chess. You know what I mean?
Now let's get to managing your debt. For better or for worse, debt is a common part of your financial life. People borrow to achieve any number of their goals.
For sure.
For example, as we mentioned in last episode, you might take out student loans to attend college.
Yeah.
Or an auto loan when you need to buy a new car, or a mortgage when you're ready to buy a house.
Yes.
You might also use a credit card or personal loan when you need to finance a purchase and pay it back over time. But debt can also be destructive to your finances. So to manage your debt, you have to learn about good debt and bad debt, as I mentioned before.
Yes.
Understand the impacts of how you manage your debt on your credit score, especially how you manage those monthly payments, and understand what a grace period is and how paying off your credit cards each month lets you avoid paying interest. Karan, and explain to our viewers what a grace period is.
Before I do that, I actually wanted to talk about the impact of debt, like in the pandemic, for the people that were there. Not when they were there, but like the people that went through it, especially who had debt, and also those that how it impacted their mental health and well-being. I think it's good that we explore like the emotional and psychological impact of debt and on individuals themselves and families. I think it's good to know what coping strategies you can have that avoid reducing your stress. It might be as simple as going on a walk, taking a jog, or doing meditation. In terms of how COVID-19 impacted your debt levels, your loan forbearance, as well as government assisted programs, I think it's best that in the essence of time, we recommend that you reach out to your parents, as I'm assuming that around 85% of you might have debt in some way or form, especially considering if you have a lot of siblings, as it can be a lot on your parents, especially immigrants, as me and you are both immigrants.
Alright, so Karan, that was a lot. So now I'll just explain what a grace period
Alright,
is.
yeah, thank you about that.
A grace period is a set amount of time during which you're either not accruing interest on your credit card debt or not being penalized for a late payment on a loan.
Yes.
Depending on the creditor and the type of debt, grace periods can last anywhere from a few days to a couple of weeks. And it can be a handy way to avoid late fees and high interest payments.
Yes.
So now let's move our balance to investing.
Wait, hold on. Did you talk about the impact of grace periods on your credit score though? That's really important because
credit score gets impacted by making late monthly payments
or just missing them. Especially.
And that also goes if you extend your grace period. If you go beyond your grace period, your credit score will get impacted.
And I would say I might as well go ahead and say this. While late payments that are reported to credit bureaus typically occur after that grace period has ended, I think it's also important to make those payments as close to the due date as possible, as if you fail to do that, it would not be good for you as a banker, private banker and stuff like that,
But Karan, explain what a credit score is.
So, hold on, let me think of the best way to put it for high school students especially. I would say that a credit score is basically a numerical representation of how you as an individual, it's your credit worthiness of the fact that you will repay the money that you have borrowed, or also just fulfilling any financial obligation that you might have. Credit scores are used by your lenders, your creditors, your landlords, insurance companies, and others to assess the risk associated with giving you money or entering those transactions with you as an individual in general. The higher the credit score, the lower the perceived risk, and vice versa. So there are a lot of things, key things that you should understand. Your scoring models and your factors that can affect your credit scores. Scoring models are basically used to calculate your credit score, with the FICO score and Vantage score being the most common. These are models that use complex algorithms to analyze your information in a credit report, and they generate three-digit scores. FICO scores range from 300 to 850, while Vantage scores range from 300 to 850 as well. Now, some factors that can affect your credit score are the ones that Muhammad's going to talk about, but I'll say the four. As I took you by surprise, didn't I? They are payment history.
I'm ready, Karan.
Credit utilization, length of credit history, types of credit, Muhammad, and new credit inquiries. However, before we do that, I would like to say that credit scores, the best ones are excellent considered, an A+ for a student is above 800, good is between 670 to 799, fair is between 580 to 669, and poor is anything below 580.
I must point out, Karan, you can't go above 800. 800 is the max.
Yes, but no, it ranges from 850. 850 is the max.
Is it?
Exactly, Muhammad.
Okay, but now I'm going to catch you by surprise. We're almost out of time, so we're going to make it up a 3-part series. Come back next episode for another part.
Especially where Muhammad will be explaining these factors. All right, see everyone.
Bye.
And keep those dreams alive, okay?